The April Fool's relief rally lasted exactly 24 hours. Yesterday, the market briefly convinced itself that a U.S. military exit was possible. Today, day 34 of the geopolitical conflict shattered that narrative entirely. Late Wednesday, President Donald Trump delivered his most aggressive primetime address to date. While claiming core objectives in Iran were nearing completion, he explicitly threatened to hit the regime's infrastructure, specifically electric plants, quote, extremely hard over the next 3 weeks. Within 3 hours of that broadcast, Iran launched its third consecutive missile barrage into northern Israel. Air raid sirens immediately sounded, and state-on-state hostilities resumed at full volume. The commodity markets reacted instantly. Traders began pricing in direct military strikes on critical power generation facilities, driving Brent Crude aggressively back toward $106 a barrel. This chart shows the traditional 60-40 institutional portfolio, allocating 60% to stocks and 40% to bonds. Normally, when equities fall during a panic, bond prices rise, creating a reliable safety net. Right now, both sides of that equation are flashing red simultaneously. The fixed income safety net is completely gone. Because the war is driving up energy costs, investors fear runaway inflation, causing the 10-year Treasury yield to violently climb toward 4.8. The dollar index has pushed past 102.40, reclaiming its safe haven dominance and actively crushing precious metal valuations in the process. This chart shows projected 2027 earnings for the S&P 500. The market is now pricing the geopolitical conflict as a permanent fixture. That war premium is functioning as an algorithmic 15% discount tax on future corporate growth. In past sell-offs, central banks would step in and cut interest rates to save equities. They can't do that today. High crude prices create imported inflation, meaning the cost of everything shipped or manufactured goes up, tying the hands of global policymakers. You can see the consequences clearly in Europe. Germany's DAX index has dropped 2.7%. With the Strait of Hormuz paralyzed, factory gate inflation has hit 4-year highs, forcing the European Central Bank to maintain a tight, hawkish grip on the economy, even as supply chains freeze. Japan is caught in a similar snare. The country relies heavily on imported fuel, and at $106 a barrel, the extreme cost of energy is entirely erasing manufacturing export margins. The Bank of Japan is deadlocked, unable to hike rates without crashing domestic credit. The institutional reality is stark. Central banks can print money, but they cannot print barrels of oil. Faced with an external, supply-side energy shock, they have lost their ability to cushion the market. Without central bank protection, the financial contagion is aggressively routing vulnerable, growth-dependent emerging markets. This chart shows institutional capital flows in India. Foreign institutional investors liquidated 8,300 crore rupees in a single session. This dumping overwhelmed the domestic buying buffer. The sheer volume broke the Nifty 50 below its 22,250 support floor, triggering widespread systematic capitulation. Yet, amid this global liquidation, one regional index remains completely insulated: the Saudi exchange, trading actively in the green. High oil prices naturally separate Gulf equities from Western inflation problems. Selling crude above $100 ensures robust fiscal surpluses for Saudi Arabia, guaranteeing high dividend visibility for heavyweights like Saudi Aramco, regardless of what happens in Europe or the US. Institutional liquidity is actively abandoning regions that depend on cheap energy for growth, and flowing directly toward the very markets that profit from a global energy chokehold. Central banks have stopped absorbing market shocks. Today, investors are navigating a landscape where standard correlations have ceased to function. This chart shows the VIX, Wall Street's fear gauge. It has spiked past the 25 mark, meaning the cost of buying derivative contracts to protect your portfolio from further downside is now historically expensive. If you look closely at the board, the only assets holding a green tick in a sea of red are deep-value defensive sectors. Specifically, utility providers and select IT firms are serving as the market's final microshelters. For portfolio managers heading into the Good Friday long weekend, the strategic imperative is simple. Because all standard logic between stocks and bonds has failed, cash remains the only reliable safe haven. This chart shows forward projections for energy. If the threat against Iranian electric infrastructure is executed in the coming weeks, institutions must prepare for Brent Crude to systematically test the $112 resistance level by the end of April. The stagflationary trap has closed. Survival no longer dictates chasing yield. It requires a total defensive lockdown, hoarding liquidity at all costs.